That product then comes to shore where it's weighed and the quality is assessed. That information, together with the fisher information, farmer information, is then with pricing uploaded to our marketplace. And then information is immediately available to the chef in the restaurant who place the order. We aggregate the order in Australia. That's where we are very differently on. We pack it in Australia. It arrives in Pudong Customs. Pudong is the international airport for Shanghai. And it literally goes straight from customs to the restaurant. So we're avoiding the importer, the wholesaler, and the last mile distributor. And so we avoid the fish markets. And with because we're using smart tagging with blockchain technology, we can guarantee the provenance of the product, and we can guarantee the ethics of the journey the product went on.
How does the blockchain technology work in this case?
Our view, Leon, is that the blockchain technology itself is honestly, it's quite straightforward. And we see many people who have built a blockchain product. Know that old movie from, I think, the 90s where they said, build it and they will come. And that hasn't worked. And so what is critical is to have all the information that's recorded up to the blockchain. And so we've worked really hardly on every time there's a change in custody of the product, that change in custody or any activity that affects the product that information needs to be uploaded to the blockchain. So we've spent an inordinate amount of time and effort making sure there are no gaps from the fisher, because the blockchain calls the fisher and farmer the source of truth. You have to start with the source of truth. If you start anywhere else in the chain, then fraud can happen. And you can't have any gaps in the information from the fisher and farmer all the way through to the consumer. You can't have any gaps, otherwise fraud can happen. So we've worked really hard to make sure that there's no gaps in the information, and every change of custody is recorded up to the blockchain. So that's how we guarantee the authenticity, Leon.
How many in the chain?
For us, well, we say right now in the traditional chain, there's many hands, and I can go through 10 different hands. But one of the things we like to say as part of our brand name is we go from many hands to 2 hands, where for us it goes from the fisher, and then there's essentially only 2 other people in the chain before it gets to the restaurant. We manage the rest. So as I said, we've reinvented the supply chain and eliminated middlemen and made it much simpler, Leon. And by making it much simpler, it's made it much easier for us to implement a blockchain application with integrity.
So you expect this will, once people start going to restaurants again in China, they'll take to it quite well?
Well, with coronavirus, it's devastated lives, and it's scared the world, Leon. And so it can't be business as usual. There must be change. And so what we're finding and talking with executive chefs in Shanghai, because they don't have much clientele right now, they're twiddling their thumbs, so it's a great time to be talking to them. What we're doing really resonates. People want to know they're consuming safe food.
That's quite significant, because Australia, of course, has a reputation of having very safe food.
Yeah, Australia, I've had the opportunity to travel throughout China, and I must say Australia has an extraordinary reputation. We're a very highly regulated country, and that might drive people crazy. But in China, they see that as a great positive, because the high regulation means things are safe and they can trust what comes out of Australia. But the issue is that I think it's wonderful what the government has done with this rescue package for food exporters. It's extraordinary. And with the JobKeeper program, Leon, I never thought I'd be saying these words, but God bless the government. They're extraordinary. But with the rescue package for food exporters, once it leaves Australia, it's still going through those traditional channels. It's still going through the wet markets that Scott Morrison is rightly saying must be shut down. And so there has to be a different model. And so we believe we've got an idea whose time has come and in avoiding the fish markets.
What's interesting there is, of course, you've got this crisis, which is not only happening in China, but right across Asia. So you've also got markets in South Korea, Indonesia, Hong
Yeah.
Kong.
Yes.
You could actually target those markets as well using your blockchain technology.
Yeah, Leon. No, the beauty of the digital age, and I think the blockchain is going to take that to another level, is that once you get the product right, and once you have a product that the market needs and wants, you can scale it up very quickly. And what we see in the future of blockchain, and we're talking about the full suite of blockchain products here, not just it seems that everyone's focused on the traceability aspect of blockchain, but my goodness, the future, the full suite of blockchain is something, it's a thing of great beauty, Leon. And that's what we're pursuing, that blockchain that is of great beauty, that can expand globally at a very rapid pace. And so that's the model we're pursuing with a public curated register. With a public curated register, you can expand globally very rapidly, but also with a public curated register, no, the copycats, the liars, and the dirty cheats can be found out and called out, and they can be eliminated. So this is the first time we have a technology that can ensure that all the participants operate ethically. And how incredible is that?
What's interesting here is, I mean, no one seems to have thought of this. I mean, what made you come to this model?
Oh, it's just weird, Leon. It's so much of our journey is serendipity, like it was meant to be. We were first approached by some fisher leaders in the rock lobster industry, Leon, who were desperately concerned about the future of their industry because the middlemen are getting bigger and they're becoming more arrogant and ruthless. And the fishers have the same boat, same size boat, they say the same size. And so they were really worried about their future. And so they approached me and said, Greg, we need a solution. And I hung up. I got this call of desperation. I hung up from them, and then I happened to just know a couple of Australians who are working in some of the best restaurants in China, in Shanghai. And I called them. I said, "Hey, listen, I've had this discussion with some leaders in the fishers industry here in Australia. What do you think?" And I said, I reckon we can connect people directly, just like Airbnb does. And I said to the Australians in Shanghai, what do you think? And they said, what a bloody brilliant idea. And so they said, can you come up quickly? And so I went up to see them. And so we worked out that we can make this happen and we can avoid middlemen. And so what we then found, Leon, is that by trying to be a champion for fishers and farmers, we could then solve a food fraud problem in China that is a shocking issue in China. Food fraud is a terrible, terrible issue. And the whole world is suffering from this issue right now because coronavirus, bird flu, and SARS all were all enabled by a food supply chain that lacks transparency and ethics. And blockchain solves those issues. And so how amazing is it? And so then we keep following down the path and we find that as we explore more about blockchain and the beauty of blockchain with its smart contracts and its public curated register, that my goodness, this is something that could bring ethics to the world food supply. And so now one of the things I like to say, Leon, is that kids, primary school kids today, they can't believe a world existed when there was no smartphones. What I say is that infants of today, when they reach primary school age, they'll be incredulous that previous generations did not know who the fisher and farmer was of the food they consumed, did not know the ethics of the supply chain that delivered that food, and they will be sitting and thankfully safe that they live in a world where ethical food supply chains will no longer enable a coronavirus, bird flu, or SARS. I think we can move quickly to that world, Leon, thanks to blockchain.
Well, it'll be fascinating to watch, and congratulations for a brilliant innovation, and the world will be thanking you. Thank you very much, Greg.
Thank you so much, Leon.
And now let's talk to AMP Capital Chief Economist, Shane Oliver.
Well, Shane, I'm a bit puzzled by the markets. It's rounded off quite a few weeks of solid gains for the US equity markets. It's up more than 20% since its lows in late March, and the ASX's index is still up about 16% since its March low. Now, I'm quite puzzled about this because stock markets are meant to be lead indicators for the economy, and this time they seem to be getting ahead of themselves because we have all sorts of economic news coming up about the impact of COVID-19, and we don't know how this is going to pan out. What's your view about this?
I think it's, share markets often surprise people. We saw a plunge in share markets from their high around about 20th of February to their low a month later. And that, of course, was at a time when many were not that negative on coronavirus. And so the share market sort of led on the way down. And I think what's happened in the last couple of weeks, where we have seen this sort of 15 to 20% rally depending on the market. The US share market's up 19% from the bottom. We're up about 16%, and it varies from day to day, of course. But we have seen a pretty good rally. I think what's happened is that several things have occurred. Firstly, a lot of bad news had been factored in. Share markets on average had fallen about 35%. Our market had come down about 37%. US about 34%. Europe about 38%. So a lot of bad news had been factored in. Secondly, you saw the policy moves by governments and central banks, massive monetary easing, massive fiscal stimulus around the world and in Australia, dwarfing what we saw at the time of the GFC. And then finally, in recent week, the last week or so, we've seen more evidence that the number of new cases is starting to come under control in various hotspots, including Italy, Spain, Germany, Eurozone generally, and maybe even New York. And of course, in Australia, we have seen the number of new cases decline quite substantially over the last week or so. So it's that combination of things, the fact that a lot of bad news had already been factored in. And so when the bad news comes along in terms of bad economic data, the market says, okay, well, we thought that was going to happen. But in the meantime, it's been offset by the policy stimulus and signs, potential signs that coronavirus might be starting to lose some of its grip.
But the reality is that while the governments and central banks around the world have flooded the economies with stimulus measures, trying to stave off the length of the inevitable recessions, the reality is the success of these measures won't be clear for months.
That's right. And therefore, it's too early to say markets have bottomed. It's a bit like you go way back to October 2008, November 2008. There was two 19% rallies in US shares through that period, from an area in late October to early November, and another one November to later in November. Many thought that's it. The big GFC bear market is over, but then of course it resumed, and ultimately US and Australian shares did not bottom until March of 2009 as the economic environment continued to deteriorate. So it's still way too early to say that share markets have bottomed. I'm hopeful they have. They often lead. We have seen the offsetting fiscal stimulus, and maybe if coronavirus starts to come under control, some of the shutdowns might be eased. But there is still quite a bit of bad news to come, and that I think could drag markets still lower. And it is quite common for share markets to go through a bit of a basing process. They come down very sharply, have bear market rallies, then you come down again and you start to see technical signs that the market is bottoming. For example, the share market going down on lower volumes to make its low, or less stocks making new lows, for example. Those sorts of things arguably haven't been ticked off just yet, but they do suggest that, we could still see more weakness in the share markets in the weeks ahead. before we can say with confidence that it's bottomed. Trouble for investors, of course, you never know with any of this stuff. It's no one has a perfect crystal ball here. There was a 20-odd% fall in US shares in 2018 to its low point on Christmas Eve. Then we saw a massive bounce a few days later, and that rally just continued. There was no retesting of the bottom at all, even though many were expecting that. So it is very, very difficult for investors to time market bottoms. And I would suspect a better approach if an investor is looking for bargains, you try and average in rather than think that you're going to time the bottom, because you probably won't unless you get lucky.
Well, how does an investor average in?
Averaging in is a simple concept. You say, well, I've got $100, say. Hopefully it's a bit more than that. You've got $100. I don't know whether we've seen the bottom or not, but we've seen a good rally, so that's a positive sign. But we could still go down again, so I really don't know. I'm going to split that $100 up into 4 groups of $25, and I'll do $25 now, $25 in a month's time, $25 a month after that, and then the final $25 a month after that. So you're averaging into the market rather than claiming you can predict the precise area where it bottoms out. Now, of course, that could be spread out over 6 months if you're worried that this coronavirus situation could extend for a longer period, or it could be spread out over 9 months. Or you might just have a strategy of buying a portion of the amount you want to put in every time there's, say, a significant dip in the market. So if it falls more than 10% over the course of a few days, then you might put some in, and then you don't put any more in until you get some more dips, or you adopt some sort of more sophisticated rule. But there are ways to put money in rather than shoving it all in at once and then being a little bit disappointed a few days later.
Okay. Now, I mean, of course, there are some dire figures about the economy. I mean, the Australian economy, data released by the ABS showed 2/3 of Australian businesses expected their turnover cash flow had reduced as a result of COVID-19. And the AFR's economist survey for the March quarter showed economists are forecasting a median 4% contraction in calendar 2020.
That's right. In fact, I think our forecast in that was -6%, and that is a year average number. We're actually looking for a top-to-bottom contraction of around 12%. So it's about a 2% contraction in the March quarter just passed, and about a 10% contraction in the June quarter, and then a little bit of growth returning in the second half. So it's going to be a tough period here. That will mean that company profits will come down to some degree. The market's already factored that in, and hopefully the stimulus measures will provide some support for the economy to minimise second-round effects from the shutdowns. So by that I mean, obviously got a first-round effect. If things are shut down, people are stuck at home, can't spend. That obviously affects economic activity, and then you've got a second-round effect if that activity, the shutdown, causes lots of businesses to go bust, lots of people to permanently lose their jobs, lots of people and businesses to default on their loans, for example. So hopefully the various measures put in place by governments and the Reserve Bank will help minimise that second round effect or the collateral damage from this, and therefore we should be able to bounce back. But yeah, there's a lot of uncertainty around all of that, and there is a lot of bad news to come.
Well, we'll see. And I mean, is it going to be a V-shaped recovery or something else?
There's a lot of debate about that, V, U, or L. I'll deal with the most negative one first. The L-shaped recovery is where you come crashing down. So the economy in Australia contracts 12%. Very hard to get a precise estimate of that. Could be more, could be less, but the economy takes a hit and we just stay down the bottom. There's no real recovery, and unemployment will just shoot higher and stay up there. I think that's unlikely. I think at some point we will get the virus under control, and there's a lot of work going on that around the world at the moment. Once we do that, we can ease the shutdowns or hopefully eliminate them once if a vaccine comes along. And secondly, a lot of the activity on the part of government is designed to protect the economy and provide stimulus for when the virus is under control. So that suggests we will get a recovery. So an L shape, I think, is very unlikely. Is it going to be a V shape? We go straight down and then almost as quickly back up the other side? Probably not. Often with these things, it takes a little while to get back up again. It may look like a V-shaped recovery when you look at economic growth. It could go, we have a fall of -12%, and then we can get a bit of growth occurring. If you graph that out, on a chart, it'll look like a bit of a V. If you go from -2 in the March quarter, -10 in the June quarter, and then say +2 in the September quarter, and maybe +3 in the December quarter, then that's going to look like a V. In terms of the level of activity, it's going to look more like a U, though, where you come down and then you only gradually get back towards more normal levels. And that probably takes us through into next year before that occurs. So I think in the great scheme of things, it probably won't be a V, more likely a U-style recovery. But the fact that we are seeing all these stimulus measures on the part of government, 10% of GDP getting pumped into the economy, massive monetary stimulus to make sure that the financial system keeps working, that the flow of credit keeps happening, and that money keeps circulating in the economy. Those things give me confidence that we will get a recovery, but it probably won't be up as quick as it's come down, but it will probably be a U-shaped recovery.
Well, Shane Oliver, we'll all be watching that very closely, and thank you very much for your time.
My pleasure, Leon.
Thank you.
Stay safe.
So what's happening in the news? Well, the International Monetary Fund predicted the Great Lockdown Recession would be the steepest in almost a century, and warned the world economy's contraction and recovery would be worse than anticipated if the coronavirus lingers or returns. In its first World Economic Outlook report since the spread of the coronavirus and subsequent freezing of major economies, the IMF estimated that global gross domestic product will shrink 3% this year. That compares to a January projection of a 3.3% expansion and would likely mark the deepest dive since the Great Depression. It would also dwarf the 0.1% contraction of 2009 amid the financial crisis. It predicts the Australian economy would shrink by a massive 6.7% this year. And global airline industry passenger revenue will plummet 55% this year, according to the latest International Air Transport Association forecast for the pandemic-hit sector. IATA ramped up its estimate on coronavirus-related worldwide losses among passenger airlines by another 25% to US $314 billion, that's 493 billion Aussie, and signalled that the turbulence could last well beyond the end of the lockdown period. We've never seen a downturn this deep before, said IATA Director General Alexander Juniak. Half our business disappears. That's catastrophic. And Amazon is to hire another 75,000 workers in America to meet demand from customers shopping from home because of lockdown restrictions. The online retailer has already brought on an extra 100,000 workers in its warehouses and as delivery drivers. Since more than 16 million Americans have lost their jobs in 3 weeks, the new posts are likely to be snapped up. And oil producers reached a historic agreement on Sunday to support oil prices, but it is unclear it will succeed in doing so. America helped negotiate a deal between the Organisation of Petroleum Exporting Countries, Russia and other allies to reduce production by nearly 10 million barrels of oil a day, around 10% of global supply, the largest voluntary output cut ever. Even more notably, the producers agreed to limit production for 2 years, yet the bargain's impact is uncertain. COVID-19 has prompted oil demand to collapse. Appetite for crude could drop by 20 million barrels a day in April. The deal's duration could support oil prices as demand picks up, but only if producers abide by its terms. In the past, Russia, Iraq and other big producers have regularly exceeded their quotas. Other countries may rebel too. Mexico's reluctance to agree to cuts almost derailed a deal entirely. Those hoping for stable, higher prices will be disappointed. And global carbon emissions are tipped to fall 6% this year, more than during any previous economic crisis or war, led by a plunge in fuel consumption as the coronavirus hits economic activity and travel. But experts say that won't be enough to achieve the Paris Agreement's ambition of limiting global warming to as close as 1.5 degrees as possible. And business confidence has plunged to its lowest level on record, even worse than the 2008 global financial crisis and early 1990s recession, as cash-strapped firms brace for an economic downturn of unprecedented speed and magnitude. The closely watched National Australia Bank Business Survey reveals government coronavirus containment measures have hit business sentiment. Business conditions dropped 21 points to -21 in March. The previous record monthly low was -17 in February 2009. On a quarterly basis, this is not as weak as during the 1990s recession, when quarterly business conditions neared -40. Confidence fell 63 points to -66. The previous record, low both monthly and quarterly, was -30 in November 2008. This was consistent with consumer confidence falling to a record low in late March. Business cash flow deteriorated in March, reflecting slowing sales and forced closures by governments under strict social distancing rules. A collapse in corporate profits caused business conditions to fall last month, with the recreation and personal services industry suffering the biggest hit. Mining, finance and business and property services all suffered sharp declines in conditions. The exception was wholesale trade, which grew strongly due to grocery retailers stocking up on essential items demanded by panicked customers. NAB said forward orders by firms fell to their lowest level on record. Business confidence fell deep into negative territory to minus 66 points. And real estate agents expect housing values to drop as much as 20% as buyers drop out of the market, prompting fears of a prolonged downturn that could force some agencies to close, according to an industry poll. The survey, conducted at a CoreLogic platform, RP Data, showed more than a third, 35% of agents expect prices to drop between 10 to 20%, and more than a quarter, 27%, expect a deeper decline of more than 20%. 30% of the agents said the hefty price decline was already happening, while a similar proportion expect the price drop to occur in the next 3 to 6 months. And unemployment is set to soar to its highest rate in almost 3 decades, with 1.4 million Australians expected to be out of work. The unemployment rate will rise from 5.1% to 10% in the June quarter, according to Treasury figures, all but confirming Australia will enter a recession as it deals with the COVID-19 pandemic. The Treasurer said the economic shock from coronavirus was set to be far more significant than the global financial crisis. It will be the first time the unemployment rate has hit double digits since April 1994, and the figure is a fraction below Australia's peak unemployment rate of 11.2% in 1992. But Treasury's estimates show the unemployment rate would be much higher and peak at 15% had the government not intervened with a $130 billion wage subsidy program known as JobKeeper. And Qantas and Virgin Australia are set to receive a multi-million-dollar rescue package to subsidise flights between capital cities after both airlines were forced to abandon much of their domestic networks because of travel restrictions crippling demand. The Morrison government is on the verge of signing off on the wave of assistance of the 2 major carriers, while admitting that overseas travel was likely to stay shut down until the end of the year. Deputy Prime Minister Michael McCormack spent the Easter weekend locked in negotiations with Qantas and Virgin executives, including their chiefs, Alan Joyce and Paul Scurra, over how the government can bolster flights for freight and passengers while keeping a lid on costs. But Virgin is considering going into administration as it races against time to get out from under a $4.8 billion debt pile. The government says it's committed to having 2 airlines. It's just not saying which 2. Amid calls from the federal opposition Anthony Albanese for the government to rescue the airline, Virgin has hired insolvency and turnaround experts at Deloitte to work on restructure scenarios. It is believed that as part of the restructuring effort, Virgin Australia has also hired the debt expert Jim McKnight of the investment bank Houlihan Lokey, who has worked on some of Australia's biggest corporate collapses and rescues, including the shopping centre Centro, toll road companies Bris Connections and Network 10. Virgin Australia has halted trading, telling the market it is considering ongoing issues with respect to financial assistance and restructuring alternatives amid the COVID-19 pandemic. And reliance on the private market to develop vaccines has failed, leaving us vulnerable to pandemics such as COVID-19, public health experts say. At least 3 SARS vaccines that may have prevented COVID-19 were cut off from funding as they are about to go to clinical trials. Meanwhile, the global coalition spearheading the race towards a COVID-19 vaccine warns it is running out of funding. Manufacturing a vaccine is much more expensive than making a drug because it often involves modifying yeast or bacteria to produce a vaccine, a difficult and costly process. Because of those factors, the enthusiasm in the pharmaceutical industry to invest in vaccines has dropped dramatically in the last 20 years. Vaccines are far more expensive to develop and produce than other drugs, and many of the potential customers are the global poor, making big pharma companies reluctant to invest. Nobel laureate and immunologist Professor Peter Doherty said the world needed to change its funding model for vaccine development. There is just not enough profit margin in it for pharma companies, he said. They live by profits and the rules of capitalism, and capitalism has no interest in human beings other than as consumers. And the coronavirus has triggered Australia's self-sufficiency push. Australia's reliance on imported products will be put under the microscope by the federal government as it pushes the economy to become more self-sufficient in the wake of the coronavirus pandemic. Federal Agriculture Minister David Littleproud has started quietly pulling together a policy roundtable from the public and private sectors. So agriculture is the industry best placed to thrive after COVID-19 restrictions are relaxed as rain soaks into drought-baked paddocks of Eastern Australia. Mr Littleproud said agriculture, even though it delivered just 2% of GDP, would be crucial in helping the nation rebound after this crisis. He was circumspect about bringing back food manufacturing jobs, but said there were opportunities for new jobs in innovation and science to boost livestock and crop yields with new farming techniques and technology. And the world's fourth biggest pension pool is bracing for multi-billion-dollar outflows and diminished returns after Australia's government allowed people hit by the coronavirus outbreak to dip into their retirement savings early. Australia's superannuation industry expects as much as $50 billion to be withdrawn over the next 5 months, causing liquidity problems for some funds. The policy, which comes into effect on April the 20th, also risks locking in investment losses as assets are sold to fund the payments amid the worst market volatility since the global financial crisis. While leading funds such as Australian Super say they have enough liquid assets to meet liabilities, they've expressed concerns about the plan and the likelihood that investors will miss the opportunity to ride the eventual market rebound. And Qantas staff are exploring options, including a class action alleging the airline failed to adequately protect them against COVID-19 after more than 59 employees became infected along with some family members. The Flight Attendants Association of Australia has begun exploring possible legal avenues for staff amid deep dissatisfaction about the way in which Qantas has handled what they say are the risks, particularly to cabin crew. The Australian Health Protection Principal Committee has now acknowledged that international cabin crew face a higher risk and issued new guidance to the airlines as Qantas gives up to begin limited scheduled international flights to Los Angeles, London, Auckland and Hong Kong. The flights will operate for a month, Qantas said. Previously, aircrew were exempt from quarantine, unlike their passengers, to allow them to maintain a semblance of normal life while staffing essential flights. And television and radio spectrum fees will be waived for 12 months, $50 million put into regional news gathering, and content quotas will be suspended for the rest of 2020 in a relief package from the government to help media companies navigate the COVID-19 pandemic. Communications Minister Paul Fletcher announced the package on Wednesday as part of an effort to help media companies, which are experiencing heavy drop-offs in advertising revenue due to brands pulling planned spending during government-imposed restrictions on movement aimed at stopping the spread of coronavirus. But News Corp is warning the spread of the coronavirus will hit Foxtel and Kayo subscriptions due to the cancellation of Mo's Live Sports, a weak listing volumes expected for its property classifieds business REA Group and Move, but says it is seeing growing digital book purchases and subscriptions for its news websites. Foxtel had been under pressure before the outbreak of COVID-19 escalated in Australia over the last month, with a declining broadcast subscriber base. It has turned to Kayo, its sports streaming service, which was launched in November 2018, as a major part of its restructure and to provide growth. Kayo slipped back over the summer months during the cricket season, and News Corp had pointed to the NRL and AFL seasons being the key for the service to take off again. But now, with the AFL, NRL and Super Rugby sessions postponed, Foxtel and Kayo have come under renewed pressure. And McDonald's has expanded the essential groceries available to customers during the coronavirus crisis. The fast food chain announced last month it would begin selling basic groceries such as bread and milk during the pandemic. And now it's added eggs to that list. The newest items will be rolling out at stores nationally over the next week. The groceries are available through drive-thrus and takeaway services. And Westpac has set aside $900 million to settle a massive breach of anti-money laundering laws in what would be the biggest fine in Australian corporate history. The potential fine is part of a $1.43 billion of charges, including increased customer remediation, that will slash first half profit, with newly appointed Chief Executive Officer Peter Keane warning further bad debt provisions from the coronavirus crisis are coming. The Sydney-based lender is still working out the extent of the expected credit losses and will provide an update before releasing first half results on May the 4th, it said in a statement. However, it expects to have a significant increase in bad debt provisions. Earnings at all of Australia's major banks are set to plunge this year as the coronavirus outbreak shuts down large swathes of the economy. Dividend payments, one of the key attractions of bank stocks for retail shareholders, are also under pressure after the regulator urged lenders to reduce payouts to shore up capital. And that's it for this week. And next week I'll be talking to Didier Moutier, the Commissioner of St John Ambulance Australia. And we'll be talking about how St John Ambulance is using technology to support its 130 strong team of volunteers to remain connected and engaged within the organisation during this period of strict social distancing. This is a critical component for the organisation as it relies on a team of volunteers who are engaged to support the community. The Granville division of St John's Ambulance exists to support its local health services with first aid support and services and equipping individuals, families and workplaces with high quality equipment. The team also has a critical role in major incidents like COVID-19, where they will work alongside emergency services in times of need. And I'll be talking to Indeed economist Callum Pickering, analysing Australia's latest unemployment figures. In the meantime, you can find me on Twitter at TalkingBizBLZZ, on Facebook and on LinkedIn. And if you want, leave a comment. Wishing you all a safe and healthy